Have you ever wondered why your dream vacation suddenly got more expensive overnight? Or why the same gadget costs less on an international website than in your home country? The answer lies in a force that silently shapes our wallets every day: exchange rates. But what exactly are exchange rates, and how do they impact the way we travel or shop globally? Welcome to Old Topic, where we uncover the hidden forces shaping your world. In today's video, we unravel the mystery of how exchange rates affect your travel and shopping decisions more than you might think. Let's begin with a simple definition. An exchange rate is the value of one country's currency in relation to another. For example, if $1 equals 83 Indian rupees, that's the exchange rate between the two currencies. But here's the twist. This rate is not fixed. It changes constantly, sometimes within minutes. Now imagine you're planning a vacation to Europe. You've budgeted 1 lakh rupees for your trip. Last week, €1 was worth 88 rupees. This week it's jumped to 92. That may not seem like a huge difference, just 4 rupees. But when you multiply that by hundreds or thousands of euros in expenses, the impact is significant. Suddenly, your meals, hotel stays, and shopping cost more. Without even realizing it, your trip just got more expensive. But why do exchange rates change? Well, there are many reasons. Interest rates, inflation, political stability, and even rumors in the financial markets can affect the value of a currency. Think of it like a global tug-of-war, where demand and supply are constantly battling. If investors think the Indian economy is growing, they might buy more rupees, increasing its value. On the other hand, if there's political turmoil, they might sell it off, decreasing its value. Let's take another real-world example. Online shopping. Imagine you're buying a new smartphone from an American website. Last month, $1 was worth 80 rupees. Now, it's 85. That $600 phone just went from 48,000 rupees to 51,000. You didn't buy a more expensive phone. The price didn't increase. The exchange rate did. And that extra 3,000 rupees? That's the hidden cost of currency fluctuation. Now flip the situation. Suppose the rupee strengthens, and $1 equals 78 rupees. Suddenly your international shopping becomes cheaper. This is why savvy shoppers often monitor exchange rates before buying expensive items from overseas. But it's not just consumers who are affected. Businesses are heavily impacted too. Say you run a small business in India, and you import electronics from China. If the yuan strengthens against the rupee, your cost of importing goods rises, which could force you to raise your prices. On the flip side, if you're exporting handmade carpets to the US and the dollar strengthens, you earn more rupees per sale, boosting your profits. So how do travelers and shoppers protect themselves from exchange rate shocks? One way is through Forex cards. These are prepaid cards that lock in an exchange rate at the time of loading. This shields you from future rate hikes. Another trick is timing, tracking the currency trends and making large purchases when the rate is in your favor. Travel agencies and multinational companies even use a tool called hedging, which locks in exchange rates for future transactions to minimize risk. But for regular people like us, a little research and timing can go a long way. And yes, sometimes even the payment method you choose matters. Credit cards often charge additional currency conversion fees, while some digital wallets offer better exchange rates or cashback. But wait, what about countries with fixed exchange rates? In some places like the UAE, the local currency, the dirham, is pegged to the US dollar, meaning its value stays stable. That might sound ideal, but it comes with its own set of challenges. These countries have less control over their own monetary policy. And if the dollar fluctuates globally, their economies feel the ripple effects. Meanwhile, countries with floating exchange rates, like India, the US, or the Eurozone, experience more frequent changes based on the open market. But here's something deeper to think about. Exchange rates don't just affect prices, they reflect perceptions. A strong currency is usually seen as a sign of economic health. When a country's currency weakens, it could mean slowing growth, inflation, or political instability. So when you check the exchange rate, You're not just seeing a number, you're seeing how the world views a nation's economy. And yet, exchange rates also create opportunities. For digital nomads or freelancers working remotely for foreign clients, a favorable exchange rate means higher earnings in their local currency. A content writer in India earning $500 per project makes more rupees when the dollar strengthens. But the reverse is also true. If the dollar weakens, their effective income drops. Even students studying abroad are affected. Tuition fees, rent, groceries, all these depend on the prevailing exchange rate. A sudden spike in the host country's currency can throw a student's entire budget into chaos. So the next time you plan a vacation, buy a gadget online, or even dream of studying abroad. Remember this silent force that can either stretch your budget or squeeze it tight. Exchange rates. They're invisible, but incredibly powerful. They travel with you, shop with you, and sit quietly in your bank statements, shaping your financial reality every day. In the end, understanding exchange rates is more than just math. It's about being aware of the world, and how decisions made thousands of miles away by governments, markets, and investors can reach right into your wallet. Thanks for watching Old Topic. Don't forget to like, share, and subscribe for more deep dives into the hidden forces behind everyday life. Until next time, stay informed and stay curious.